Well, let's now welcome in Neelkanth Mishra, who's joining us this very busy morning, Chief Economist at Axis Bank and Head of Global Research at Axis Capital. Neelkanth, good morning. Great to have you with us here. I'm sure you've been poring over the details and, of course, talking to your team and getting a sort of view out there. So I just want to get that view, Neelkanth. I remember speaking with you 2 days before, 2 or 3 days back, and you said it's just going to be the opening gambit and it's going to linger. We won't get clarity and it'll go back and forth, but this basically means a lot of uncertainty. What has been announced is much harsher, Neelkanth, would you agree, than what anyone thought?
Yes. The fact that the impact is not $300 billion, but closer to $700 billion is of course much bigger. The market should, I think, start getting used to the fact that uncertainty will now accentuate. So not only should we expect some countries to retaliate, we may also see significant currency movements starting to show up in the next several weeks. And as the negotiation process kicks off, because remember that these are, they have deliberately started at 50% of what they think is the effective barrier. I mean, how it has been calculated, there are enough social media calculations on how simplistic it has been. But whatever be the case, they've started at 50 because I think the assumption will be that, look, we are going to raise it further if the negotiations are not doing well. If you start to retaliate, we'll raise it further. Either way, the estimate that I put out the last time we chatted, that about 1% of global GDP at the very least of investments can get postponed because of this. I think that estimate now needs to be revised further. The $700 billion odd of extra revenue that on an annualized level the US will start now to collect is about 0.6% of global GDP. So this is effectively fiscal tightening for the world. The US, of course, not all $700 billion will come from foreign producers. For example, if you take the smartphones, if production in China and Vietnam is going to be up more than 45 to 55%, or more expensive, and that from India about 25% more expensive, I mean, the US consumers will have to pay because there's not going to be any smartphone production in the US immediately. So there will be quite a bit of that $700 billion that will actually come from US consumers themselves in the form of higher inflation. And frankly, it's only through higher inflation that tariffs actually become effective on what the US government is trying to do. So, but the US government will have some tools to provide some solace, some assumption, some comfort to the US consumers through some other tax cuts. But the gist is that this is a straight first shot 0.6% of GDP, global GDP. The postponement of production would be another 1%. I think we are talking about a significant rise in uncertainty for financial markets.
Neelkanth, sorry, just to get those figures in, 1% hit to 1% hit to US GDP, right? Or global GDP?
Global. So
1% hit to global GDP.
Because of postponement of investments. Okay. In addition to what is actually a 0.6% of global GDP tax that the US is now collecting or wanting to.
Okay. And you briefly mentioned that enough social media posts about how this number is being calculated simplistically, etc. We had an ING economist in the morning who said, well, and he used the word, not I, he said fabricated number. So they divided the deficit by imports and arrived at that 52%. Is that really so? So they're taking the size of bilateral trade, the overall bilateral trade, and it's got nothing to do with tariffs per se, the rate of tariff. Neelkanth.
Yeah, so if you plot the gap between MFN, see the executive order talks about how, this started around 1934 when the US government started to have bilateral agreements, and then over time it transitioned into a global agreement, and there was a most favored nation MFN rate that was being offered that is not any consistent, and so that is how the justification is made. But when you look at, and therefore India actually on this is slightly better off because India's MFN rates were much higher than the effective tariff that has been imposed. Like India it was 17%, but the tariff, they have calculated is about 45-50%. In Vietnam, where the effective MFN rate, average rate was 9%, their effective rate is 81%. So, which is why I think there are various other factors, and I don't think it is possible to quantify the impact of non-tariff barriers very efficiently. So some of the speculation on how this may have been calculated is right, but remember that the objectives remain the same, which we had discussed the last time. Multilateralism is over. The US does not want to get hollowed out industrially, and the dollar they want to depreciate, though I don't think this is going to help. And thirdly, that they want to generate out of revenue out of imports. So all of those three objectives are what I think we should solve for.
Okay, got that. By the way, Neelkanth was talking about currencies. So I'm just taking a very quick look at what the currency markets are indicating, global markets, and there are big moves playing out. Look at the yen. The yen has surged, which you would expect because of the risk haven, the risk of nature of trade. The yen is now quoting at 147 to the dollar, and that's a straight move of 1.3%. That's the kind of rise the yen has seen. The euro is stronger because the euro as a bloc is coming together with very strong statements saying that, we will stand together and we will do whatever it takes to sort of mitigate the impact. The euro is at 1.09 now. That's a 0.5% appreciation for the euro. This is all this morning trades that are taking place. The yuan has weakened to about a 2-month low. But even for the yuan, the reference point that the PBOC sets every morning is stronger than what the markets had anticipated. So that's a little bit on the currency side. Neelkanth, great to be listening into your views. So for someone sitting here in India and watching all this, a very simple question. Should we feel slightly relieved because we are not as badly impacted as a lot of the Asian exporters, export-facing economies? Or is there a lot of reason to worry because of the second and third order effects? What you said, 1% being shaved off global growth itself, which eventually will come back to hit us as well.
I said more than 1%. I said 1% because of investment getting delayed. That's a broad ballpark back of the envelope, Nick. And in addition to the 0.6% of volatility.
In addition, so it's 1.6%, yeah. Overall impact on the global economy, yeah.
Exactly, which is at the first shot, right? And so now we have to see second order, third order effect. So this is not going to help anyone. And I think previous speakers have also mentioned, and it's a reasonable number to work with, that we are slightly less affected directly. And remember that many of the problems that we had self-inflicted on ourselves, we are starting to solve them. Like the liquidity side, I think the RBI has been very proactive and it has shown a lot of action after stating its intent. And therefore, the liquidity premium that existed, which was very significant and which was actually slowing down the economy, is now very quickly getting whittled away. So the domestic economy actually should be on a better footing for its internal demand. So India economically, I think, will be less affected. There may even be new opportunities that come up. So if Vietnam is not in a hurry to bring down its tariffs, then there is a lot of apparel, footwear. India becomes relatively cheaper. I mean, there's a 20% gap between Vietnam and India. Tariffs on Vietnam versus tariffs on India. It's an advantage that can actually start to play out in our favor. I mean, it's very unlikely that footwear and apparel will start getting manufactured in the US because of these tariffs. So there may even be opportunities that come our way. But the channel through which I think the impact will be the worst will be the financial markets. So remember that people are just about starting to cope with the fact that this uncertainty will be there for a long time. The Fed put that the markets had become addicted to over the last 3 decades, that whenever there is a problem, the Fed can cut interest rates and the things will get sorted out. This time, it is a much, much more complex problem. And the equity risk premium, which is the inherent uncertainty, which prices in the inherent uncertainty of returns in what is actually a much riskier asset class than bonds, is something that was too low and will now start to rise. So we should get used to lower price to earnings multiples. This will get priced in over several quarters and years, but I think it would be, while we are less affected because of this, in fact, the gap, as I said, between MFN rates and what has been imposed is perhaps India is much better off. Second, we are less exposed to global trade on the good side than we have than many other countries. And thirdly, our own economic headwinds that we had created for ourselves are now starting to ease. So economically, I think we'll be fine. But I think the financial markets, the currency markets, I think are going to get badly affected.
All right. Hi, Neelkanth. Good to hear your thoughts. And as you said the last time around as well, equity markets could be in a bit of a dizzy and could be in a bit of a flux, as you had mentioned last time around as well. Just want to clarify a couple of things. For the Indian GDP forecast, do you see any kind of hit? Are you factoring in anything? You've already mentioned longer term that could be throwing up an opportunity because the tariffs on India are not as much as some of our peers. So in select sectors, there could be opportunities. But in the near term, are you pulling back GDP estimates by any amount? And also, what about the RBI? You know, the Fed is unlikely now to go ahead and cut as much. At least that's the feedback we've got in the last few hours. Do you think the RBI has it in them to effect a couple of more rate cuts for the remainder of the Yes, please.
Any change that happens over a few hours can very quickly reverse over the next few hours as well. So remember that as the economy starts to slow in the US, and it is reasonable to expect that growth will slow because even though tax cuts may be introduced, there will be a lag before they start to show up, but the price shock will be immediate. So we'll see, I mean, how that plays out. In fact, it could actually happen that the US goes into a very sharp slowdown, and in which case the Fed then sees room to cut rates. So those things will change. I think that's something that we have to get used to. But when I think about the Indian economy, see the headline level, which is the easiest to do, if you exempt pharmaceuticals and some other sectors, and you focus on what is the change in duties, effective duties, and assume that in the next 6 months, by September, I think the assumption is that the bilateral trade agreement will be done, and by then India would have actually negotiated down some of these rates. The actual impact would again be only about $10 billion. And as of now, it seems it's 15-20. But it is wrong to expect that all of that will be borne by India. I think it is reasonable to expect that, like we discussed about smartphones, that some of the a reasonable part of that cost will be borne by the US consumer, because there's no way that those kind of price cuts can be offered by Indian producers. So I don't think the direct impact is that big. I think the second order effect, because of the prolonged uncertainty, the fact that global GDP itself may be slowing, that there could be IT services.
Sorry, Neelkanth, go on. Sorry, go on.
So the prolonged uncertainty, think about what happens to, say, IT services exports. So those are the kind of things that we should worry about. So versus yesterday, today, is my GDP growth forecast going to be lower? Absolutely. Will it be 1 percentage point lower? Will it be 0.5 percentage point lower? Too early to say. But I would re-emphasize that I think RBI's rate decisions are going to be far more affected by how good the monsoon is, how the hailstorms are affecting yields of wheat, how monsoon shapes up, rather than what the US Fed does. On the currency market, there may be some more volatility. I think you were asking the previous speaker about FII flows. Clearly, in this uncertainty, people will pull back from EMs, especially given that we are in the same basket as China and Vietnam and Thailand and many other countries which are very badly affected. So on the dollar flow side, I think RBI again will have to factor in the fact that they may have to intervene again to protect the rupee.
Got that. Neelkanth, I had a couple of questions. One, do you have a specific view on pharma? Because pharma today, from a market point of view, is rallying. It's been exempted for now, looks like, but they've made a special, they've put pharma in along with other sectors like semiconductors, etc., where they're saying it's part of a review and sector level tariffs may still come. Or you think we should go with the fact that, well, it's not going to come? It's not happening. It's exempted. Do you have a strong view?
There is no way to have a strong view when you're not controlling the decision-making process, so you don't even know how the decisions are being taken. You only understand the broad objectives. Frankly, on pharma, this is not something which is very critical for labor and job creation. And I'm not sure if the US wants to disrupt a very large part of their healthcare system. So my understanding, my assumption would be that And given that, the manufacturing cost gap between India and the US is like 80%. So it's very unlikely that that's going to come in. It'll only increase costs, increase, insurance premiums and all that. So frankly, I don't think this will get affected. This is too small for the US to bother about. And it is too critical for affecting, the support base of the Republicans. So I think the risk is lower, but you're right. The reason they have given is that these are critical. There are things that we don't have. So we need to sort of keep them out for now. Whether they will pull it back when there is a negotiation happening between China and US and India and US and say that, you know what, we are now bringing this back on the table. Those are kind of things that can happen, but at this stage, I think it's reasonable to expect that they will not be.
And Neelkanth, Prashant, by the way, you're asking Neelkanth the hardest question, almost asking him to read Trump's mind. I don't know if his advisors or even his wife can really read what he's about to do next, right? But maybe she has an ear into these things.
I just want to ask Neelkanth one thing, Neelkanth, and you'll have a good sense of this, right? You said India is domestic facing, and so that's a good thing. So in that sense, lesser impacted economically because of these tariffs. Do you think the government and the RBI is already starting to do it, kind of, put all their efforts towards sort of really priming the economy in that sense to be able to withstand this global hit a little more? RBI meets on the 9th of April.
Yeah, but see, RBI has already taken a lot of action.
Correct.
Remember that they had taken out about 5 lakh crores, 5 trillion rupees of liquidity because of the dollar interventions between September and January. They have now re-injected 5.5-6 lakh crores, and
it was more from the fiscal side, Neelkanth. Sorry, government side.
So government fiscal deficit. In fact, the government is already going to be less of a headwind. Remember that this whole narrative that the government was supporting the economy and is no longer because capex growth is not happening as fast is absolutely wrong. The government's fiscal deficit fell by 80 basis points of GDP in FY24. It fell by another 80 basis points in FY25, and it's basis points in FY26. So the government is less of a headwind than it was. And remember that it is because the Indian government has stuck to its consolidation path that the 10-year Indian government bond is one of the safest assets in the world right now. And you're seeing yields come down. We are seeing for the right reasons, demand-supply reasons. And therefore, I think from the government's perspective, I would expect that, slight more push on domestic demand factors. Remember that we also have the advantage of having a real estate cycle, which is coming off of a 10-year downturn. It's only been 2-3 years of an upturn. There's a lot of room for growth there. So some of those policies, I think they can be definitely supportive of domestic activity levels. Even as the world goes into this reset.
So finally, Neelkanth, and last question, which will be a good segue into our next discussion as well. You discussed pharma. I just want your final take on two more important sectors from an export sense. They were important for India, apparel and textiles, of course. And then there's electronics, where so much work has gone in the last couple of years. Do either of these two sectors, do you think they could potentially stand to benefit? Because other countries have been slapped with tariffs, which are far higher than where we are as well.
Absolutely. I do think so. Given that on a relative basis, now if the formula is what it was, then perhaps it explains why India's tariffs are a bit lower. But either way, the fact that India was losing out on apparel and footwear because we didn't have an FTA with the US and Vietnam and Bangladesh with their relationship with the EU and US were benefiting. Now that these sort of tariff walls become less extreme for India, will become relatively will become an advantage. Similarly, on electronics, there is so much more that can happen out of India. Think about the fact that one very large smartphone company, despite being part of PLI, had actually shifted production, most of it incremental because they were losing global share, had shifted production to Vietnam. Or was doing more in Vietnam than in India. Maybe now it's an opportunity for them to start doing it in India. So there are things that can happen.
But Neelkanth, on electronics, I'm just going back by everything that we've heard on iPhone, right? Because Trump always takes these, poster boys of the US dream, whether it's Harley Davidson or whether it's the iPhone, And he's been saying that why can't we make these iPhones here? And we know there's a fair amount of investment that's already gone into Foxconn's factories. The Tatas are manufacturing for them. The Apple stock, by the way, was down 6% overnight on the fears that a lot of this perhaps will have to go back to the US. So are you still confident about electronics exports as a story, growing story?
Yeah. See, remember that this is the first salvo. We don't know what the bilateral trade agreements between India and the US are going to show up. The fact that the US wants to do more semiconductors is understandable. Does the US have the manpower, which can assemble smartphones at a wage rates of 12 to 14,000 rupees a month? Is something that I think cannot be changed by tariffs. So if the concern is bilateral tariffs, I think it's the US interest. So remember that they're trying to solve for their self-interest, the end of multilateralism. They're trying to solve for generating revenue out of import tariffs. But they also realize that economically it is no longer viable for them to be assembling stuff in the US or even doing, say, camera module assembly or display module assembly. So these are things that economically are just not viable in the US. And if India does the right negotiations and can bring down the tariff rates on certain items, they will get the right rates for importing in the US, exporting to the US as well. So I don't see this as an insolvable problem, or that electronics now the story is over. I think that would be a wrong interpretation.
All right, absolutely. And Neelkanth, really appreciate you joining us with that perspective. Really helpful as a frame of reference to think this through. And you may want to, if you are so inclined, can listen into the next conversation.